Well, hi everyone, and welcome to the Buffett and Beyond Weekly ETF video letter, and this is for Saturday, June 17th, 2023, and the scope of our video today is the rally is definitely broadening. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week, well, let us look at the equal weight ETF. Now, we are talking about the S&P 500 because the S&P 500 that we all hear about is capitalization weighted. That means the bigger stocks that have more shares outstanding will influence the index much more than a small cap stock that has just a few shares outstanding and a lower price. So price times number of shares outstanding is the capitalization method. It's what we hear about. But what we look at is the equal weight ETF of the S&P 500, which is the RSP, and that means that each stock has an equal weighting, and so each stock movement of, let's say, 1% has the same effect as a Microsoft that moves 1%. So we want to see what the rest of the stocks, other than the Microsofts and the Amazons and the Nvidias, how they are influencing the index, the S&P 500, and we can see that all the way down in here, the equally weighted stocks, in other words, the other 490 stocks, were not doing very well at all, and it really put a scare into everybody. And then right here, right in here, we got a buy signal where the market went down further down here, but this indicator made a higher low. Again, market made a lower low, this indicator made a higher low, and then a few days after, this indicator turned up. So that means people are buying, the market participants, you and me, are buying the rest of the S&P 500 rather than just the top 10 stocks that we all hear about and we all have in our portfolios. Now let's look at how it looks. The black line here is the S&P 500 that we always hear about, capitalization weighted, and the yellow line is the equally weighted S&P 500. And you can see how the S&P 500 was slightly climbing a little bit, or actually doing nothing if you measure the high point to the high point in here. And this is all of May between these two lines, and you can see the rest of the, and I want to call them 490 stocks, but it's not exactly that, it's probably less, but they were going down, so there was no market participation. And you heard that time and time again, that it's only the big stocks that are carrying it. And then just in the beginning of June, so this whole square in here, or this whole rectangle, is June, and then all of a sudden the market, or the whole rally, started to broaden out, and people said, wow, this is way oversold, so let's start buying some of those smaller stocks. And by small stocks, I'm not saying they're small stocks, they're just not as big as Microsoft, they're not as big as Amazon, they're not as big as Google. So we are looking at this and we are saying, well, the market is going up, and it's including all the stocks in the market. So that's a good sign, and we're going to see more of that in some of these other charts. Now let's look at the XRT. Why? Because we looked at it last week and the week before, and we are waiting for the XRT, the retail ETF. We're waiting for some of those retail stocks to take off. And the retail sector is moving up, as we can see. And right in here, it has gone above the 200-day moving average, which is this red line, and it has tested it 4 days in a row, including this line right here is Friday. But the intermediate term indicator is pointing up, so that's good. It's not as robust, it's not nearly as robust as the other ETFs we're about to look at, but at least it's starting to go up. Because some of the stocks that we looked at, here they are, these retail stocks. We're looking at Tractor Supply, BJ's, Amazon, Etsy, Dick's Sporting Goods, and over the past week they have gained a whole percent. So where the S&P has gained 3% over the past week. And the top 5 stocks here that we picked are almost doubling the ETF itself, which is our top stocks, are supposed to outperform the ETF itself, but still 6.4%, while the overall S&P 500 is up 15%, is nothing to yell at. But we're still waiting for some of these stocks to at least take off. I mean, my gosh. Everything else is starting to move. The retail sector is not, and what they're saying is that everybody's spending money on plane trips and vacationing at the hotels and going to the beaches, and they're not buying stuff. So, but pretty soon the consumer rules, and they will be buying stuff. It's just a matter of time. So let's go to our favorite semiconductor, or our two favorite ETFs, and the first one is a semiconductor, and we can see we got a nice buy signal in here. That was beautiful, and then the intermediate term indicator turned up, and this thing is just starting to shoot to the moon. Here come the top 5 stocks, folks. Yeah, you're not going to believe this number, but 2 weeks ago our top 5 stocks were up 64%. 64.9%. Now the top 5 stocks are up 75.9%, with the S&P up just 15%. Now the ETF is up, and this is a semiconductor ETF, is up 30%. Our top 5 stocks are 2.5 times that, or 250% better than the ETF itself. So you can see where the power is. It is in the semiconductor stocks. Now let's look at the technology sector. What a nice ride this thing is on, isn't it? What a beautiful, beautiful chart, getting ahead of itself. Because remember, we talk about reversion to the mean. Blue line is the 50-day moving average, and we are getting ahead of that 50-day moving average by quite a bit. And we expect a reversion to the mean. And it doesn't mean that the index itself or the ETF itself has to drop. It could stay the same, drop a little, go sideways for a while, and the 50-day can catch up to it. That is also considered reversion to the mean. Of course, look right in here. It didn't drop very much at all, and the 50-day moving average came up to meet it. But this is reversion to the mean. This is reversion to the mean, and so we're looking for something like that in the XLK, which is the Technology Selector ETF. Now let's look at the stocks. And 2 weeks ago, the top 5 stocks were up 41%, and now they're up 48%. The XLK itself is up 40%, which is, wow, very, very good. S&P is up only 15%, and the top stocks in the technology, 48%. Very, very nice, folks. I mean, these are numbers we haven't seen in a very, very long time. Well, since 2000, our 30 stock portfolio was up a little over 40% in 2000, with the S&P up about 15% or so. That was the year of COVID. Remember that? Yeah, who wants to? All right, let's look at utilities. And the utilities, folks, one thing about the utilities is that we have a hard time picking out 5 of the best stocks in the utilities. The utility index, or ETF, pretty much follows all the utility stocks, and which they're supposed to do, but it's hard to pick out 5 stocks. So we don't really, unless we're selling cover calls on some of those stocks, which will increase the income or add to the dividends. But we can see in here, right in here, it was very, very oversold, and then all of a sudden a pop-up and then a decline right here, and once it moved up, that's the buy signal right there. And just a couple of days after that, the intermediate term indicator turned up. Not nearly as good as the technology or the semiconductor ETF, but you can see the utility ETF is approaching its 200-day moving average, and this is with interest rates going up. That's why this index has had such a hard time, because people buy utility stocks for safety. And folks, I'll tell you what, I've been through several market crashes, and when the market crashes, even the utility stocks go down. But it represents a really good buying opportunity. So you can see how, with interest rates going up, how this ETF fell, and then it rallied a little bit, and then it fell again to test this bottom in here. But it was this little indicator that gave it away, and then this intermediate term indicator started to turn up. So it's doing pretty well too. Not as much as our growth stock ETFs. Consumer discretionary, very nice, very nice. And the point I'm bringing out here is that this is a broadening market participation situation where now all the stocks are starting to catch on. So that people who did not get into the rally way back in October are now forced to get in. And you can watch the TV programs with the money managers that are on there and the technicians that are on there, and so many of them have been calling for a decline, recession, hard landing, soft landing, and what they did is they missed the rally and kept a lot of their powder dry, and so now they're being forced to go into the market because their clients are saying, hey, wow, some of these ETFs are really up in high double digits, and what are you doing? And I talked to a friend of mine just about a week ago, and he says his portfolio has done nothing, and that's because he's been in a defensive portfolio. And the defensive portfolios that we look at and the dividend growth and income portfolios that we look at are all lagging the market by a little bit, while the growth portfolio, our growth portfolio, is now up 32%, our top 30 stocks. So we have growth stocks in that portfolio, but in the dividend growth and income and the defensive portfolio, they're not growth stocks and they are lagging. And what's lagging? Yeah, those retail stocks, aren't they? And so those are usually fairly defensive. I mean, when we go into a recession, the defensive stocks, such as retail stocks, actually fall because people just stop buying for a while. They'll go to the dollar store, Dollar General, or something like that. So let's look at consumer staples, and yeah, same story. You can see that people are starting to buy into the consumer staples stocks just like they are the retail stocks. So just starting to get into some of those. So the market has legs in here, folks, because if those stocks haven't been bought yet, and of course, why haven't they been bought? Because people are still thinking about recession. The economists out there are still saying recession. But don't forget, the market, when we find out we're in a recession, that market has taken off. And any recession that I've been involved in, and there's 40 years of recessions that I've been in the market, and that's what happens, folks. The market is already on its way up when we realize that we're in a recession, because the market understands that the next thing is no recession. So we go into a recession, and it knows that this Federal Reserve has a pretty good handle on things, and that even if we do go into a recession, the Fed will start to loosen up, and the market has already taken off by then. And let's look at the healthcare. The healthcare, we're looking at this because it's a defensive ETF, and it hasn't been that defensive, has it? I mean, look at this decline in here, then this decline in here. But we had a stock this past week, United Health, which is in the health business, and it took a big fall of about 7 or 8%, and now has recovered about 1 or 2% of that. But you can see that this ETF is having a hard time in here. You know, it took off and then it dropped back, and now it's going up above the 200-day moving average, which is good, above the 50-day moving average. And you can see that on Friday right here, it has been testing, went down and trying to test that 50-day moving average, but the intermediate term indicator is up like on most ETFs. So we have a broad rally going on here, folks. And remember, we had a big week. We have a 3-day holiday coming up. So folks, go out, forget about the market for at least 3 days, and we'll be back here on Tuesday. You enjoy yourself. You stay healthy. You stay safe. Be with your loved ones. Have a good weekend, folks. We'll see you next time.